you can enter into a partnership with Facet, as I described before, where we transition the smaller clients over to us and we pay you, a couple of years before you're thinking about bringing your company to market, because then when you come to market, you have a very attractive asset. Your margins are higher, you've got some capacity, you probably have some organic growth, and there'll be people lining up to buy you at a pretty high multiple.
Welcome to the Fueling Deals Podcast, the podcast that teaches how to accelerate your business growth through all types of deals. It's time to fuel up, so buckle in with your host, Corey Kupfer.
There are only two ways to grow your business: organically through sales and marketing and providing great products and services, and inorganically through deals. Too many companies focus only on the first way, organic growth. Welcome to the podcast, which will help accelerate your business growth inorganically. My guests are a huge variety of deal makers and experts on all types of deals who have personal experience that can help you grow, get clear, learn best practices, and avoid mistakes. We discuss everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My guest today is Lisa Rapuano. Lisa is the CFO of Facet Wealth, an advisor focused on bringing holistic financial planning and investment management to the mass affluent market. Facet provides full financial planning through a dedicated CFP professional to its clients at a low annual subscription price. Prior to Facet, Lisa spent 25 years managing money, first at Legg Mason for Bill Miller, and then in her own hedge funds. Lisa, welcome to the show.
Thanks so much for having me.
So it's so great to have you. I definitely want to hear more about you and what Facet Wealth does and the kind of deals that you've experienced. But before we go there, I want to take you back to when you were a little girl growing up. What did you want to be? Because I could be wrong, but being involved in hedge funds and now in the wealth management space, might not have been it back then. But tell me if I'm wrong.
Definitely was not a hedge fund manager as a little girl. That was not my ambition. I actually grew up in Cocoa Beach, Florida, and my father was a literal rocket scientist. He worked in launch control during Apollo Soyuz and all through the Apollo program. So I wanted to be either an astronaut or a physicist.
Oh, I love that. So, it's like Cocoa Beach brings back some good memories for me in that it was the freshman year of college. It was my spring break location. And all I remember was I had never surfed before that, and I've never surfed since. But I spent a week surfing in Cocoa Beach and then drinking beer at the Thirsty Turtle pub.
Oh my goodness. Small wave capital of the world, right? So of course you were surfing, and that was my upbringing, surfing and riding my bike on the beach, and not quite the Thirsty Turtle, but maybe a little later.
I love it. So what would you consider your first, real business, whether you owned it or you were as a kid later in life, or a significant executive position? What was the first real business experience you had?
I would say that when I was 25, I talked my way into a startup investment management company. I'd had, a couple of jobs on Wall Street before that, right out of college that, we're sort of sitting there in Never Never Land. You're out of college, you don't really know what's going on. You're pretty much a glorified gopher at that point. So my first real business experience was at this company called Franklin Street Partners in Chapel Hill, North Carolina, where my husband was going to business school. And I was 25, talked my way in, said, I was a third employee, and I basically convinced the guy that I could do whatever needed to be done, which I then did. I answered the phones, and I did the computers, and I managed their performance, and I did the marketing and the sales, and then I ended up, starting my research career there. That's how I kind of fell into doing investment research.
I love it. So you got, connected to the investment advisory space, the investment management industry pretty early in your career.
I did, yes.
So give us a little bit about, the high level of what Facet Wealth does.
So Facet is a registered investment advisor, an RIA is the term we use in the industry, right? But what we do that's different is we focus only on people with less than $1 million. And the reason that's important is that while $1 million is a lot of money to a lot of people, in our industry, $1 million is not enough, really, which is shocking. So a lot of people in America, 33 million households that are in our target area of having between 100,000 and $1 million in investable assets, are really sort of left out of the holistic financial planning side of the business. So what Facet has done is we have created a technology-enabled service. We use a lot of technology to create an incredibly efficient back end that our advisors use. And we're able to bring this really high level of service, of white glove service to people that don't have, that aren't rich, that aren't high net worth. That's our main business. The other thing that you should know about us, though, is that our go-to-market strategy is very cooperative with the industry. So because I mentioned earlier, many RIAs don't take people with less than $1 million or less than $500,000. What we're trying to do is create a partnership mentality in the industry where we help other RIAs by giving those smaller clients a great experience so that the RIAs can focus mostly on what they do best, which is the more complex, higher net worth folks.
So that's, that's really interesting to me. And when I first heard about Facet, it was interesting to me from a couple of points of view. I mean, one, yes, you're absolutely right. If you speak with almost any financial, advisor, whether they are frankly at a wirehouse or an IBD platform or independent, that $1 million number is what they, almost all of them talk about, million and above, million and above. Now, we all know that's to some extent, they'll make exceptions sometimes if it's somebody that has growth or it's a kid's account or whatever, but that seems to be the standard. And there are some other solutions that have come out in the industry, right? Robo advisors and, some of the things that, it's like Vanguard, are doing with their personal advisor services. But you guys have distinguished yourselves in a number of ways, including that very different go-to-market strategy.
Yeah. So the thing that you said that all these independents, IBDs, advisors are focused on the over $1 million and that they make exceptions. So the problem is if they make too many exceptions, their businesses don't work.
Yes.
Because that's really what they're set up to do, is to do those higher net worth folks. And so that's why, our strategy of partnering with them, I think, is really innovative and will be very successful in that we help them have a better business. On the other point that you mentioned, which is that there are other solutions out there like Robos and Vanguard, et cetera. I think it's great that these exist. Everyone who is looking for financial advice has a little bit of a different set of needs. There are lots of folks who kind of think, I got this, I want to do it myself. There are a lot of folks out there that don't want to do it themselves. A Robo is really an investment solution with some modest planning tools that you can self-serve on. Facet is a full advice. You have a person here. We have a dedicated person you can call for anything. We're your person, just like somebody at Goldman Sachs Private Wealth Management would be.
Yeah, which is great. And when we think about it in terms of the RIA firms, that you're partnering with, it's something that I think really makes a lot of sense, because whether it's in the investment advisory business or in any other business, right? Certainly any kind of service business, there's often this thing you alluded to, which is that too many companies are trying to be all things to all people, and it doesn't work, right? It's very difficult, in fact, near impossible for almost every firm to run a highly sort of high-end, high-touch, customized, high-end, a service, whether it's investment management, whether it's accounting firms, law firms, business coaches, I mean, you name it. And then also handle smaller, lower, profitable or lower-end clients, and that's nothing, they're great people, right? It's just that it's a different market, and there's a different level of service that you can provide at different sort of price points and profit margins.
Exactly. So I think that what you said at the beginning of the question, which was about advisors are trying to be all things to all people. The most successful advisors are not doing that.
That's right.
The most successful advisors are defining their niche very clearly. And so ours is, people with less than $1 million who want full financial planning. That's a very clear niche, and that's all we do. I think that, you'll find advisors who have built their businesses over the years, maybe have changed their targets or maybe they started in a certain area in order to just cover their fixed cost structure. And now as they've evolved and become more successful, they can't really let go of that. And it's holding them back, right? It's holding them back as they try to continue to grow, because the thing that limits our growth as an advisory firm, as any advisory firm, is human capital. And you can only do so much. So if you're a single solo guy and you have 100 clients and 50 of them are not profitable for you, they still take up your capacity. So you can't grow anymore if you don't sort of do something in order to help those clients in a different manner, and then allow yourself to fill that capacity up with more higher revenue clients who are more in sync with your newly defined, more advanced, competitive advantage or niche that you've defined.
And it's interesting because I see that issue or evolution happen not only in wealth management, but in you name the kind of business. And then you have a lot of these consultants who come in and say, hey, you got to segment your clients, right? Client segmentation. You got your A's, your B's, your C's, or whatever their segmenting strategy is, and it makes sense. And they identify that who your ideal clients, whether that's by revenue, size, profitability, type of specific niche, etc. And then who are the ones that really aren't the great fit for you. And what I find sometimes with my clients and people I know, entrepreneurs, is that they intellectually understand that the quote unquote C clients, and again, I don't want that to be a judgment on people, right? That's just those clients aren't the ideal fit for the business model that they have. Some of them are hesitant to make the move. One, because they're afraid to lose the revenue, and that's a separate conversation. They shouldn't be, and they'll be more profitable and replace them with better clients. But also sometimes because they know that they're good people, they want those people to be served. And whereas a lot of the consultants tell them that they should drop the C clients, so to speak, they don't know where to send them, and they don't want them just to have to fend on their own. So that's why I think your model really makes sense, because you're providing a solution to that dilemma for the advisory firms, as opposed to just having some consultant tell them they should cut those people.
Yeah, exactly. So, there's a couple of things that we see all the time. We talk to, hundreds and hundreds of advisors. And one thing we often see is they segment and then they don't do anything.
Right.
Because it's too difficult. This is actually the best part and the worst part about our industry. The best part is the reason they don't do anything is because they're helpers, and they just can't bear the idea of these folks not getting the help that they deserve. And that's a fabulous sentiment. It doesn't help them as business people. That we think that, Facet is an incredible new solution for them, because once we take the time to show them what we will do for those clients, the advisors generally feel like, oh, okay, what a relief. Thank goodness I can have confidence that they're going to be taken care of sending them to you, versus, their options before were somewhat limited. They could send them to Vanguard and have them do it themselves, or even send them to Vanguard with the new PAS, which, you don't really get a dedicated person unless you have over $500,000.
Right.
And it's financial planning, but it's financially oriented planning. Whereas what we do is whole life financial planning. Everything about your life, we want to help you with. You could hire a junior advisor and, segment them off over there, which adds complexity to your own business, right? You got more people working for you. You got to train someone. And then guess what? When that junior advisor becomes very successful, they don't want the small clients either. Or you could send them to retail, which is generally expensive for the client and really isn't the whole solution that we at Facet can give them. So we provide a new way for them to solve that problem. And we find that is, welcome in the industry.
So Lisa, this is a deals podcast, as you know. So let's talk about the deal that you do, because, there are a number of ways that some of this could be structured, right? There can be some sort of referral. And by the way, listeners, this is something, for those of you who are in other industries, it's an interesting thing to think about, right? Are there other resources out there, like the resource that Facet's providing in the wealth management space, in your space, where you can have your segmented clients, that aren't the perfect fit for you, be taken care of? Or if not, is there a business opportunity in your industry to, use Facet's model in the wealth management industry to do something in another industry to provide that segmentation. And then in terms of structures, right, it could be set up as a referral, relationship where you're getting paid for the clients that are referred over. They could be set up in the wealth management industry as some sort of sub-advisory relationship where there's an ongoing client relationship. You could buy the business, from the other firm. So I'm curious, Lisa, as to what your model is, and then people can extrapolate out for themselves in other industries as well.
Sure. So I'll talk about what we're doing with RIA firms as the deals between us.
Yes.
But there's another element here that I'd like to come back to, which is how we can help advisors who want to do deals amongst themselves.
Great.
And how we can play a role in facilitating that. So if you don't mind coming back to that, that would be great.
Yeah, that's right.
So the deal that you do with Facet, we refer to as a partnership. It has two flavors, essentially. One is a referral partnership. And so in the RIA space, we can pay for referrals if you have a solicitation agreement with us. And that is an ongoing thing. We become the person the trusted advisor to whom you send clients who are below your minimum, and therefore you never get in that problem again where you have all kinds of small clients taking up your time. You solve the problem and then you never have it again because you have Facet. That's one flavor. The other flavor is what we call the revenue replacement opportunity, which is much more, it sounds more like a sale, an asset sale. It is more of a deal. The reason we call it a revenue replacement opportunity is that it's rarely like a big giant transaction deal that all happens at one time. It's more of a ongoing sequential deal. So we sign an asset purchase agreement with an RIA where we are purchasing their client relationships from them. That is an asset which they own. We then set terms on that, which are around how long we will replace their revenue for clients that transition to us. Mm-hmm. So if you have 100 clients that are below $500,000 and they're making you $25,000 in revenue, what I do is I look at that and I say, this is how we're going to pay you for these as they come over. And because this is a business improvement opportunity generally for the RIA and not necessarily, a deal, a transaction, they're not selling a practice, they're just selling certain client relationships. This works really well for them because one of the big reasons they haven't done it before is they don't want to lose that revenue. So I'll tell them, look, I'll replace your revenue for 12 to 18 months for all the clients that come to Facet. And you then have fewer clients, more time, and the same revenue for 12 to 18 months. And that's what we find is the really transformative thing for an advisor, is that they use that time to do all that stuff they've always wanted to do. Their revenues are not going to go down for 12 to 18 months. That's a long time when you freed up anywhere from 10 to 50% of your time by getting rid of your small clients. And that's how they start their own organic growth engine again. That's how they start, sort of revving up their marketing machine again. That's how they find the time to meet the strategic objectives that they really hadn't had time to get to before.
So that's really smart. And, and listeners, from a deal maker point of view, there's so many things in that. But one of the things I want to point out is, there's so many ways to structure deals, right? And some people get sort of really stuck in some traditional structures. And one of the things that you always want to look at when you're structuring deals in any given industry is, what is the target, on the other side of your deal? In this case, for Facet, it's these RIA firms who have a desire to segment out, certain of their clients and not handle them, but a hesitation to do so. And what is the pain point that's associated with that? And what is going to make it attractive to the other side? And what Lisa just explained to you in her case is that that revenue replacement, right? Because they don't want to lose the revenue, so that's a pain point for them that makes them hesitant to do it. She's solving, and Facet's solving that concern, which frees them up to be able to pursue more ideal clients, or do whatever else they want to do. Maybe look for acquisitions. We'll talk about that later, or have a growth strategy that's that is more in line with their ideal clients. So that's a lesson for the listeners out there in any industry. And other aspects of the wealth management space, if you can solve a pain point for somebody in your deal structure, it makes those deals much more likely to get done.
Right. And just to be clear, we didn't start out with this particular structure, right? When we envisioned this at the beginning, we thought this would be more transactional, large book buying, traditional close techniques. And what we found is that that's not the product market fit. This was completely market driven of how advisors want to work with us, and we adjusted.
Yeah, which is another great lesson, right? Is that, listen, I mean, you always hear listen to the marketplace in terms of what your client wants in terms of just your basic service, your direct service offering. But it's the same thing in deals. Sometimes you go out to market with certain thinking on a deal structure, and the market tells you it wants something different. And if you're smart and you can make it work in a way that's, makes sense economically and otherwise for you, you adjust. That's great. So Lisa, let's talk about, let me see if I can segue into that other topic, which you mentioned. It seems to me like there are a number of scenarios in which it would make sense for somebody to consider Facet, and a few of them, so one of the things we do is we work with a lot of breakaway brokers who leave, teams who are leaving warehouses and, banks and trust companies who want to go independent. And one of the decisions that they make at that point is, they may have some lower end clients. And the question is, do they take them with them or do they leave them, at the wirehouse because, they're not their ideal clients. That's one scenario. The other scenario where it comes up, which is, I think, the segue into what, the other topic that you wanted to talk about, and I think would be valuable to our listeners, is when companies are doing deals, when they're doing mergers, acquisitions, et cetera, that's another time where they look at the profitability of their clients, maybe on their own, but also because often the buyer is doing that analysis and, deciding what it wants to pay for and also what may fit its business model, especially maybe if a smaller firm is merging, or being acquired by a larger firm, and there are different minimums and that kind of stuff. And it seems to me like that's an opportunity where you guys get involved as well. How did I do on that segue?
That was perfect. Very nice. So you're right. There are different ways that we can work with advisors who are considering M&A activity on their own. I'll characterize them in two different ways. One is the preparation for M&A advisor, and one is in the middle of M&A advisor. So let me talk about the preparation for M&A guy first. Woman, guy, person. In a situation where, let's say you're an advisor, you might be starting to think about selling your practice down the road. You might be starting to think about creating a G2, a generation 2 transition. You're starting to think about your company as more of a business and less of a practice, and you're trying to get your ducks in a row to maximize its value. We're a very good partner at that point of consideration where you start to move toward maximizing the value of your business. Because if you think about Corey, you probably do this all the time, right? You look at an RIA and they got a whole bunch of really small accounts. Their profit margins are going to be lower. The competitive advantage they have with those smaller accounts is going to be smaller because they probably don't give them a ton of service. It's a little bit confusing in their branding because they're talking about how they're an ultra high net worth advisor, but then they got, all these people who are not ultra high net worth, and it can be kind of confusing in the community as to what they really do. There's all kinds of reasons that it can be confusing. So you can enter into a partnership with Facet, as I described before, where we transition the smaller clients over to us and we pay you, a couple of years before you're thinking about bringing your company to market, because then when you come to market, you have a very attractive asset. Your margins are higher, you've got some capacity, you probably have some organic growth, and there'll be people lining up to buy you at a pretty high multiple. The other circumstance, which is the midst of transaction advisors, that we can also be helpful, is if you're a buyer, for example, and you find an asset that hasn't gone through that pre-work that I just described, but they've got a nice core there that you really want. So they might have, $100 million, and of that 100 million, 80 of it is very attractive to you, fits right into your power alley, culturally great, but you got this $20 million of AUM that is just not at all. You really don't want to take it on. We can be a very attractive partner for coming to help you with that, either prior to you buying it or after you're buying it, one way or during. We can structure it in a variety of ways in order to bring those clients to a home like Facet that is perfect for them, and to bring those other clients to your asset manager, your investment manager, your wealth manager, in a way that fits perfectly with you. So we can get involved in a variety of ways to maximize the value of practices and also give clients their best home.
Yeah, and both those situations really make sense because, doing as many deals as I do, I often see that come up as an issue where whether it's during the buyer doesn't want a certain segment of the clients because the advisor still has those, and hasn't done anything with them. Or they, and I love the other aspect that you brought up where it's one of the ways that a buyer can get prepared for a deal because there's so many, one of the things we always talk to people about when they're thinking about selling the company, whether it's, for succession purposes over time or other reasons or whatever it is that, there's a lot of things you want to do to prep your company to make sure that you're in the best position to attract the most buyers and also get the highest valuation. And there are things around cleaning up financial statements and getting legal things in place and making sure that you have, the better systems you got, securing your key people. And, there's a whole list of things. And this is certainly an important one to at least consider adding to the list in advance of well in advance of a transaction. That's great. So any other thoughts in terms of, what you're seeing in the RIA industry, and deals in general, or, any other, is Facet, obviously you will not reveal any confidential information of things coming up, but I mean, what is is there anything on the horizon, or how does that, in terms of the way Facet looks at deals for maybe, yourself or anything else that might be interesting?
Yeah, Facet, our model is these small sort of asset sale purchases, not really wholesale RIA purchases. Mm-hmm. So I can confidently say that we don't have anything in the works to buy other groups. But I would like to sort of just comment on the overall consolidation in the industry.
Yeah.
Because I think that it points out a couple of very interesting trends that we should all keep in mind as we build our businesses. I also, to be totally self-serving here, right? They happen to also really underline some of the assumptions we've made about the industry going forward. So I'll just say in advance that I understand that all of these things I'm about to say make us look really good. But okay, so one of them is that there are reasons that you're seeing consolidation, not just because of generational shift, which a lot of people are talking about, but it's also because companies are needing companies, and by companies I mean wealth management companies, investment management companies, and wealth management companies. They're really needing to look internally and say, what is it that I do well that makes me deserve my fees? And, if you go back to the olden days, like when I was starting out, there were, a lot of investment only people, a lot of stockbrokers, which is what we still called them back then.
Sure.
You would hire them to pick stocks for you. You would hire them to give you access to the market at very high commission trade rates, if you remember that. And, that was very valuable, right? It was hard to play the market back then. And then it's morphed over time into, giving you better managers, better mutual funds. I worked for Legg Mason for a really long time. The only way you could get our mutual funds, which were amazing, was to have a Legg Mason broker. And so that was kind of the next iteration. And now we're moving into an iteration where it's all about service and personal attention. Well, you know what? Personal attention and service is expensive and difficult to give to people. And I think some of this evolution of the industry is what's driving the consolidation.
And at the same time, there's significant margin compression on fees.
Yes, exactly. Because you have to earn your fees, right? So the robos, God bless them, they really accelerated the commodification of, market participation. That was already getting commodified with ETFs, but now having robos, it's so easy, right? It's so easy to be in the market for a very low price. And so if I'm hiring an advisor, what am I hiring them for? Not that, right? So these advisors are moving up market. they're moving toward offering more service. This is a really, really good trend for clients. But it's going to just make it harder for advisors to continue to earn their fees. And so that's all what I'm saying is that I think that deals will continue to accelerate. I think, the United Capital thing, Focus going public, all of these consolidators that are out there, this is all a natural evolution of the business. And we who are participating need to very much examine how we're adding value to our clients, and are we charging them a fair price for what we're doing for them.
Yeah, and it's interesting to me because I've in other talks I've given, and probably earlier podcasts and some of my writing, I've certainly been quoted in articles. I get some of the industry press comes to me when there's these deals, whatever, or investments, venture capital money coming into the space, or Focus's IPO. I mean, we're just in a maturing industry. I've seen it. I've been practicing law for over 30 years. I have clients outside the industry as well, and this is what happens in a maturing industry. There's consolidation. There's margin compression. There's investment capital that comes into the space, and what smart firms do, and listeners, if whatever industry you're in, it's a good lesson, right? Because some people sit and complain about how industries evolve, but they're going to evolve whether whatever you think about them, and it also provides opportunity. I mean, frankly, Lisa, probably 10 years ago or 15 years ago, there wasn't a space in the market for Facet Wealth.
No, absolutely. And you're 100% right. It's a maturing industry. I think we can look at just the pure asset management space as a model of what we probably don't want to do, right?
Right.
Which is to not evolve and to not adapt and not to continue to make our product, irreplaceable for people, right? So the fees, maybe we don't, I would like to think of it not as so much as fee compression as service expansion, right?
Yeah.
If you want to keep charging 90 basis points or 1% of AUM, you better darn well earn that with incredible service to those clients.
Love it. Love it. So, Lisa, before I ask you my last question, I'm sure that listeners have gotten a huge amount of value, and you've certainly gotten some in investment advisory firms who light bulb has gone off on their head, whether it's just the opportunity to segment out their clients in general, or in connection with a deal that they're doing, or otherwise. So, if people want to reach out to you, what's the best place to find out more about you and Facet Wealth and to get connected with you?
Well, email me directly at lisa@facetwealth.com. I'm happy to direct you to whoever the right person is to talk to if it's not me. And also, I would encourage you to go to our website at www.facetwealth.com. We've got all kinds of resources about what we do for clients and how we work with advisors that will probably be very helpful to you.
Oh, that's great. So my last question on the podcast is always about authenticity, and it's one of my highest values. And for me, authenticity is not about external morals or integrity. Those are different conversations, related but different. But it's all about, having our lives and businesses and decisions aligned with what's true, our innermost truth, what's authentic to us. And, that could be looked at on an individual basis, in terms of, even your decision to be at Facet Wealth. And it could also be in a company culture, which ideally it's both, right? So I would love to just get your thoughts around how authenticity has impacted your business career in general, and how it may play into what Facet Wealth does.
Well, let me talk about Facet Wealth's role in authenticity first, because that's the easier question to answer. So there is something incredibly powerful about joining a company that not only has a really good business idea, which I think our business idea is very powerful, but also is helping people every single day, people who would otherwise be either not given the service that they deserved or charged way too much for it. And that is, we have a Slack channel here at Facet called Dreams Made Possible, where we just post stories of how we've helped people, how they got their first house, how we helped them pay off their credit card debt, whatever it is. I mean, we're here to help people and to build a good business doing it, which I think is a really rare and valuable thing, right? I'm really lucky to be associated with it and very happy to be here.
I love that. I love the idea of the Slack channel. That's phenomenal.
Thanks. Yeah. I mean, we take it really every two weeks. Also, we listen to client calls where we listen to what clients are saying about us, what their problems are. It helps our engineers. We have a lot of software engineers here who are building our product. They're building the interface for the clients. They're building the interface for our financial advisors to use, our CFPs to use, and to get, to be incredibly efficient in serving our clients and meeting their needs. And so having everyone hear kind of what client problems and solutions really are is very helpful to driving our success and driving our product and our service offering.
Great. And the other half of that question?
Well, the other half is about me personally, right? So it's interesting. I think that I got a lot of satisfaction in my life out of managing money, to be honest. For 25 years, that's what I did in the public markets. And, I worked for Bill, and we were very differentiated in the marketplace. And so I think that it's that differentiation that we had where we really were investing differently. We weren't playing a game. We weren't taking people's money and trying to sort of meet the consultant-driven metrics in order to gather the most assets. And we made a lot of people a lot of money. Before I left in 2004, we were very, very successful, and that was very satisfying. When I started my hedge fund, there's a reason that I was not particularly successful as far as hedge funds go. I mean, I was successful in that my life was amazing. I got to do exactly what I wanted to do, serving very, very nice clients and investing exactly the way that I wanted to, but which was the way I thought was correct. But it didn't scale because I didn't play the game. And, you hear out there people that are just trying to make a buck. And if I had wanted to make a lot of money, I mean, I made fine money, but if I'd wanted to make a lot of money, like hedge fund kind of money, I would have structured it in a way that I knew would play the game and would sell. Mm-hmm. And instead, I structured it the way that made me happy and capitalized on my particular strengths. And I think that there's something to thinking about your life that way and thinking about structuring a business that way so that, you kind of get to do exactly what you're good at and what helps people the most, but you don't necessarily always have to do it in the way that makes the most money or gathers the greatest number of assets.
I love that, Lisa. It's been such a pleasure having you on the show.
Thank you. It's been a pleasure to be here.
And thank you, Fueling Deals listeners, for tuning in. Remember, there's only one difference between companies that grow inorganically and those that don't. And it's unrelated to size, amount of capital, or any other factor, other than that the owners and executives that do deals make a decision to do deals. And then they take action. Well, it's time to refuel. So until next week, Corey Kupfer signing out.
Thank you again for tuning in. Be sure to leave Fueling Deals a rating and review on iTunes and Google. Check out all our episodes at fuelingdeals.com to find out more resources to accelerate your business growth.